Hello, I'm Michael Haynes with in for Andrew Bell. It is Market Call with David Burrows. He is the president and chief investment strategist at Barometer Capital Management. There he is. He's getting ready to take your calls, emails, tweets, video questions too on North American large caps. If you've got a question, we've got a line open, 1-855-326-6266. You can email us, marketcall@bnn.ca, or you can tag us on social media. We'll try to get your question answered ASAP. Mr. Burrows, welcome back.
It is great to be here.
We have the Americans indicating that you've got another interest rate increase coming before the end of the year, and then maybe 3 more for 2018. What does that mean for stocks?
Listen, we are in a long, slow expansion that's been going on for quite some time now. We have very little excess built into the system, so it makes sense that they would work to normalize interest rates. It's important that they do that, and it probably speaks to the confidence that the Federal Reserve has in the sustainability of the recovery that we're in.
Do you have the confidence that the right move is to raise the cost of borrowing before the end of the year, considering the economic data we'll get out of the U.S. is going to be skewed by, well, hurricanes?
Yeah, no, I absolutely do. And I think the market agrees. When you look at what it is that's working in the U.S. equity market, it's a reflationary trade. So industrials are leading the market. Financials are as well. We're seeing a little bit of rotation from long duration assets like technology to sectors that are more cyclical by nature, basic materials, for instance. So market's telling you the same story. So I think it is important for them to continue just to work their way through this. And they're trying to be very clear and transparent and telegraphing to the market what they're thinking.
Having said that, the bond market, which is often considered, those guys take the longer view, and the stock jocks are the ones who get distracted by shiny objects.
Yeah.
They're not as confident that the U.S. economy or the global economy is going to reflate as fast as the Fed does.
Well, look, you know, Europe is working hard at keeping rates lower, right? And so is Japan. But you look at the yield in the 10-year bond, yields had come in a little bit leading up to 2-3 weeks ago. And I am of the view that we saw secular lows in long-term interest rates last June, so 16 months ago, and I think that we had a little pullback in yields coming into this spring. I think that actually bonds do not look very attractive, and I think the bond market is showing some signs that they're taking notice of the fact that there's going to be balance sheet normalization, and I think yields can go higher over the next number of months.
Canadian dollar has been knocked off its perch. The loonie is down, 2.5% or so from the early September high. I guess it was inevitable that the U.S. dollar rout would come to an end at some point.
Yeah, look, if you track the economic surprise index in Canada, so whether economic data is coming in ahead or behind of expectation, and you track the difference between the economic surprise index in Canada, which has been getting better, and the economic surprise index, which in the U.S. was getting worse for a couple of months, that spread got very significant. Now U.S. economic surprise data is getting better, Canadian economic surprise, so it's bound to come in. And I think that the move was exacerbated by what I think may be a policy mistake in Canada in the interest rate increase here.
In what way?
Well, look, a large amount of the GDP growth in Canada has come from residential real estate, which we know has been coming off the boil. We know that a lot of that purchasing was overseas purchasing. Chinese purchases of overseas real estate, forget Canada or Toronto, globally is down 85% year over year. So that's being driven by capital controls in China, not by our regulation. So that has an impact. Construction has an impact, and auto sales in Canada have been selling at a greater rate per population than they were at the peak of the auto boom in the U.S., and that's driven by confidence in real estate.
Okay, but what about the counter argument, which is we saw what happened in Vancouver when they brought in anti-foreign buyer measures. It bounced back after an initial decline. We learned from the real estate associations that something like 5% of all transactions in Toronto were foreign versus 7.9%. That doesn't seem to be a substantial amount. Okay,
so remember, first things first. Vancouver is a more finite market than the Toronto market is. It's geographically constrained. Okay. Second, when the changes were made in regulation there, it was before some of the more significant capital controls came in China, which are not about Vancouver. They're about overseas buying.
Sure.
The last thing is, in a commodity or an asset, the last marginal buyer sets the price for everybody. So you take out a certain percentage of those buyers, it's very easy for something that's supply constrained to come off the boil. So I think it's unlikely that real estate transaction costs, commissions, are running at 3% of GDP, which is almost 3 standard deviations above the norm. Residential real estate spending close to 8% of GDP, and that's way above the norm. So it's unlikely to expect it to continue at that rate. I'm not saying it's going down a ton, but if that slows down and the home equity loan bubble that we're seeing in Canada slows down, then maybe auto sales slow down a little. And it's less likely that the Canadian economy is perking along at this rate, especially having seen the Canadian dollar rally, which puts a bit of a lid on some exports.
We got the Organization for Economic Cooperation and Development on line 2 waiting for you on that. David Burrows is here, President and Chief Investment Strategist at Barometer Capital Management. We're talking North American large caps at 1-855-326-6266.